Good morning, everybody. My name is Greg. I am an engineer at Goldfinch, as well as a been building a DAO called LinksDAO on the side. Here with both Rennick and Eli from Stratos Investments, and we're here to today talk about investments, yield opportunities, different types of stablecoins in the ecosystem, what the different types of risk and rewards that you can kind of get, and where some protocols that you can start looking into to find opportunities to park your capital. So maybe I'll just kind of kick it over to Rennick and Eli for quick intros, and we'll kick it off from here.
Thanks, Greg. Good morning, everyone. Thanks for joining us. I'm Rennick. I founded Stratos. We invest in income-producing assets as well as equity with a focus on digital assets. And I'm also a founding team member at Goldfinch, or what was Goldfinch, and now Warbler Labs. And yeah, happy to talk about stablecoins and yield in crypto.
Hey guys, I'm Eli. I'm on the investment team here at Stratos. I work with Rennick. I've spent a lot of time, searching for low risk, high reward stablecoin yields. I think it's less common, these days than it was in like DeFi summer of 2020, but there's still a lot of opportunities. So I'm excited to talk about it.
And Mike, would you like to introduce yourself?
Yeah, sure. I'm Mike. I am one of the co-founders of Goldfinch and on the Warbler Labs team.
Great, awesome. And to people in the community, if you're interested at any point, feel free to raise your hand. We'll dedicate some time at the end for Q&A, but if you have any insights that come along during this chat, feel free to chime in. So I'll kind of kick it off with the first kind of question to the panel. I think the first thing is kind of thinking through what types of different stablecoins exist in the ecosystem. Maybe you can go through some examples of them and what type of kind of rewards and yields can you kind of get on these stablecoins in different parts of the ecosystem. So maybe I'll kind of just kick this off to you, Rennick, to kind of just talk through different types of stablecoins that might exist here.
Sure. Yeah, well, I think it's worth noting that stablecoins, in the scheme of things, are still a relatively new thing. Stablecoin supply has grown a lot in the last 2 years. I think total, we were doing the math, it's somewhere in 150 billion plus today of total stablecoins outstanding, which I think is interesting to note. We also have this view, and happy to let Mike expand on it, but that when you have prices of other crypto assets like ETH and BTC and everything else falling or staying flat, that drives more demand for stablecoins, and is part of the reason why we think this is a good time to have this conversation. But there are a couple of different types of stablecoins. The general purpose of a stablecoin is to be stable, but stable relative to typically the US dollar, as a way to hold your money in digital assets without taking the risk of other digital assets and their exchange rate volatility relative to the dollar. So the key types, the most well-known today, are either secured or collateralized stablecoins. So a secured stablecoin basically means if you have $1 of USDC, which is one of the well-known secured stablecoins, that means there's also $1 somewhere backing that stablecoin. And so we can talk about why that's important later when we get through the list. The other kind is collateralized, which is similar to secured, with the exception that the assets backing that stablecoin is not the same. It's not basically a dollar. So it's something like ETH or BTC. It's an underlying asset that might have some volatility, but since there's more collateral or more dollar value of assets per dollar of secured collateralized stablecoin, that gives you the confidence that it's going to always be worth at least $1 if you want to redeem it. And then the last is an algorithmic stablecoin, which is a stablecoin that has no collateral per se. It's not backed by anything, but there's some system behind it that enables you to exchange $1 of that stablecoin for something else. And so when that stablecoin changes price relative to the peg or relative to $1, there's an arbitrage mechanism or some other economic incentive for people to exchange one asset for that stablecoin and drive the price back to where it's desired to be. And so all of these different stablecoins have different positives and negatives to them. And for example, a secured stablecoin is great because you always know that there's going to be $1 behind it, or you think so. So that's one of the issues with Tether, USDT. There's some uncertainty around what's actually behind it and whether it should actually be worth $1. So far, it has been. I know of a lot of hedge funds that are betting that that's not the case, and they're trying to short Tether. That's a whole other conversation. But USDC is very well trusted. You know, it's the collaboration between Circle and Coinbase, and you know they've been much more transparent around the balance sheet that's backing those assets, and so that is very low risk. But the challenge is, you know, there's no sort of money creation there, in the sense that for every USDC you create, you have to park $1 in a bank account or money market account somewhere. So those are the positives and negatives there. Collateralized is the same thing, but more extreme. If you want to mint one DAI, typically you have to have, you know, at least 1.4 dollars worth of other assets securing it. And if for some reason those asset values decline, then they get burned or liquidated, and then the DAI gets burned, so that there's always at least $1.4 securing every dollar worth of DAI. So that's kind of, DAI is one of the first that ever existed as a stablecoin. I think it was the first. And then there's algorithmic stablecoins, which we talked about. The risk there is the whole system kind of collapses, essentially. There's like a death spiral where the stable coin relative to $1 falls in price. So let's say it's trading at 90 cents to the dollar, and then whatever arbitrage mechanism exists to create an economic incentive for people to push that 90 cents back up to $1 by buying it and exchanging it for something else. People decide they don't want to do that anymore because the something else that they exchange it for, they don't think is worth anything or isn't worth enough to create that strong economic incentive. So an example of that is UST and Luna. And so when UST falls relative to the dollar, there's an ability to take, let's say, for example, 90 cents worth of UST and swap it for $1 of Luna. And so you can make that 10-cent spread. And so when you're doing that on tens of millions of dollars, it can be a profitable trade for what should be no risk. So that's the arbitrage mechanism. But if, for example, people find or decide that they don't think Luna is worth anything, or there's not enough Luna out there to swap for, then that system can stop working. And then, you know, you obviously lose the stable part of that stable coin, and then no one really wants to hold it, and the system kind of unwinds. So I'll stop there.
I'm looking over the collateral on DAI right now, and just to give somebody some insights on that, that's about 41% ETH, 34.5% USDC, 11% wrapped Bitcoin, and then about another 10% of additional assets such as Uni, Link, Yearn. So the markup there is a diversified over collateral. And I think that, like, one more to call out is some of the more kind of modern but higher risk stable coins that have been created in the ecosystem, such as MIM, which is kind of taking over collateralized approach. I'm sorry, they're taking LP receipts from Curve and kind of using that as leveraged stable coins, which is kind of something that we've been seeing in the ecosystem recently too. But maybe I'll kind of kick this next question off to Eli. Like, when you kind of balance your risk versus returns in these stable coins, like how do you kind of approach this first question, and how do you kind of consider tooling, and where do you like balance your stable yields versus rewards of the governance tokens from each of these parts of the ecosystem?
Yeah, thank you. So I think Rennick actually touched on a lot of the risks that we think about. You know, it's kind of standard to view, USDC as kind of the safest stablecoin. And so, when we see opportunities that are USDC based, we kind of view those as like a tier above. And then I think the other kind of differentiator is like what sort of like strategy it is. So, basically the options are, lending stablecoins. So that would be on like Aave or Compound or Goldfinch. And then the other option would be like basically providing liquidity to like AMM pools on Uniswap or SushiSwap or wherever. Um, of those options, I think that, you know, the there's USDC, USDT pools that are fairly safe. Unfortunately, yields on a lot of these, like what I would call blue chip DeFi protocols, have come down quite a bit. So, you can still get 3% to like 5% on your USDC, USDT. But if you're looking for, I guess, kind of improved yields, you can use things like Curve and Convex, which is kind of an interesting relationship. As you mentioned, MIM has a lot of interesting opportunities. And then I think the other thing I'd talk about, like the higher risk, but higher reward opportunities, they kind of exist on, I guess, like these alternative layer ones that are still kind of in bootstrapping phase. I view those as much riskier because, a lot of these DeFi applications that are ported over haven't really been battle tested the way stuff on ETH has been battle tested. But, you can achieve, 10%, 20% yields on some of these things. And then I think the other thing you asked about was like, the true like stable yield versus, basically governance token inflation. I think you can handle that a couple ways. One is just as soon as you receive your governance tokens, you just sell them. And then the other is if, you're excited about the project and you want to be involved, or, the governance token is receiving some sort of cash flow, then you might want to hold on to the governance token because that offers you better upside. So it's kind of a case by case basis on what you want to do with those governance tokens.
Great. Anything to add on there, Rennick or Mike, that you wanted to just chime in?
No, I don't think so. But I think it is interesting to note, the difference in the sort of governance reward, kind of the token reward race, as well as like the base race on the stablecoin. Like on the Warbler and Goldfinch side, we spend a lot of time just like talking to various folks in the community who are looking to provide liquidity into different kinds of protocols and understanding how they think about it. And a lot of what we're hearing is most of the emphasis seems to be on the actual stablecoin yield. That's where people really are sort of clued into and what they're focusing most on. And then When it comes to the tokens, frankly, a lot of the folks we're talking to, I think they plan on basically selling it right away for the most part. When they care about the token, like they'll just go and buy it essentially. But when it comes to actually using their stable coins for yield, they sort of plan on just like selling the tokens. So when there is liquidity for the tokens to do that also they just kind of add it up. But a lot of the focus is on that sort of base yield on the stablecoin.
Yeah, and I'm just looking at I'm just going to read out some yields that I'm looking at around the ecosystem right now on a few of these assets, and then I'll let you kind of chime in there, Rennick. But like, just to give some people some insight, so USDC on Compound right now is at 1.98% base yield, and then 0.75%. So you're looking at 2.75 there. Aave's just under that at around 2.4, give or take. DAI on Compound is upwards of 3.5%. While on Aave, it's at the 2% number. So, right now, these base yields on some of these blue chip protocols are at the between 1.5 and 2.5% yields on the base APY. And it would be really interesting just to hear like what other opportunities are in the ecosystem that might provide more strategic, I guess, more fixed base rates in the ecosystem that might be available. But go ahead, Rennick, with what you were going to say.
Yeah, so I wanted to come back to risk for a second and how we think about the different types of yield that's available. So you can separate the yield, as Mike was saying, between governance token yield and stablecoin yield. And so the governance token yield has a lot of variability to it, which is why people tend to kind of discount that. And then there's or when I say discount that, what I mean is they think of that as being something that's variable aspect of their return. And so when people are looking for very consistent yields, they don't necessarily integrate that component of the income as being something that's consistent. So they discount it, or they say, if there's 10% yield, I'm only going to expect to get 2 or 3, over time. Then there's the stablecoin part of the yield, which can be sourced in a couple of different ways. So Eli was talking about collateralized debt protocols like Compound or Aave, are the best known, where in our view, that's the lowest or one of the lowest risk forms of yield, because essentially you're over collateralized by another liquid asset, and the key to maintaining that collateral is the liquidation mechanism, where if the value of that asset relative to the loan value falls, it will get liquidated. And so we've seen enough really volatile periods in crypto where these protocols have been active at scale to know that liquidating function works well and has proven itself to work in these volatile environments. And so we view that as being very, very low risk. The next part is the LP stablecoin AMMs. So yeah, you could be, for example, providing liquidity to a USDC, USDT pool. And essentially the risk you're taking there is this depegging risk, because whenever you provide liquidity to a DEX AMM pool, essentially the risk you're taking there is you get paid a portion of the fees that get earned on that trading pool, but your risk for that is impermanent loss from the assets changing in value. And so that's the same thing here in a stablecoin, although the expectation is that stablecoins will stay stable. Sometimes they don't. And so that, in our view, is more risky than a staking to a over collateralized debt protocol. And then you have things like Goldfinch, which is kind of a new form of on-chain yield, because it's taking off-chain real world yield and bringing it on-chain. And it's really the only protocol that does that. So in our view, that's a new way of getting yield on-chain that has a different risk profile than the other two that I mentioned, but also has a more sustainable level of yield. Because if you look at the other two forms, and you can see it in the data today, the yields have just compressed a lot because there's a lot of stable coins out there and there's not as much demand to borrow them or to swap them as necessary to maintain really high yields. But if you look at Goldfinch and lending to real world borrowers, it's a multi-trillion-dollar market. And so Goldfinch can get to pretty huge scale and still offer very attractive stablecoin yields, and also do it in a way that, in our view, is lower risk than some of the other forms of stablecoin yield on chain, because it, like the collateralized debt protocols like Aave and Compound, also has actual collateral. It's just real world assets, not on chain assets.
Yeah, I think the latest I looked at global debt is around somewhere between $200 and $300 trillion of global.
If you look at
cap.
all of it, it's the biggest asset class in the world by far. The U.S. public equity market total market cap value is somewhere in the mid-teens trillions, depending on what day you look. So, that includes Apple, Google, Facebook, all these massive companies, and yet still the global debt market is 20 times the size, which is pretty crazy to think about.
Mike, I would love to kind of hear from you what type of either fixed or variable yields Goldfinch offers, and I would also love to hear from Eli a little bit about other fixed yields in the ecosystem and what the risks are there. I know Anchor has been a pretty hot topic of discussion on crypto Twitter over the past couple of months, and I would love to learn a little bit about what's going on there and how that differs from Goldfinch.
Yeah, sure. I can speak to Goldfinch at least. So there's two primary ways of participating in the Goldfinch protocol. The first is to supply capital to what's called the senior pool. And the senior pool is kind of like the automated diversified portfolio on Goldfinch, where it's automatically supplying capital into all of the individual borrower pools that are coming onto the protocol into the senior tranches, which means that it is sort of protected or backed by the first loss capital of all those junior tranches, which are generally like 20% or so of those pools. And so in this sort of diversified kind of automated portfolio, the rates are like it's just USDC, and on the USDC base rate, it's right now 6%. And then when you include the rewards from the token, it totals out to right now 20.1% APY. And so on the senior pool, these rates are kind of fluctuating based upon how much capital is in the senior pool. But like generally speaking, over the past several months, it's been in the range of 5 to 8% base USDC, and then 20 to 30% total APY. And then the second way to participate in the Goldfinch protocol is in individual borrower pools. And these are where borrowers are proposing essentially loans that the backers can participate in these junior tranches. And so this is the more active kind of higher risk, higher return option, where you provide capital that takes losses first before the senior tranche in the event of a default. And so in return for doing that, you get larger rates. So the recent pools that have been getting funded have a USDC rate that is in the range of 15 to 18% APY. That's the base USDC rate. And then when you include the tokens that you receive as well, then the total APY ranges in the 35 to 50% APY rate. So those are the current kind of yields that are on Goldfinch today.
Yeah, so I can take the second part of your question, Greg. So just, touching on Anchor for a second. So Anchor is a lending protocol built on Terra, which has gotten a ton of buzz lately because it's kind of consistently been offering this super high yield of like 19.5% for about a year now. And the way that they are basically paying that yield has been a bit controversial because the way Anchor works is basically borrowers have to put up collateral in the form of like these yield bearing assets. So they're called bonded assets that come from Lido. So they currently take like bonded ETH and bonded Luna. So those assets are actually being staked to delegates. So they're earning, the ETH2 staking rewards and then the Luna staking rewards. So the idea is that, the collateral itself is yield bearing, which should boost, the payout you can pay to lenders. And so on the lending side of things, you deposit UST. So, you already kind of have this underlying risk that, Rennick mentioned when he was talking a little bit about the algorithmic stablecoin. And then, it still doesn't quite explain, how they're paying this 19.5% APY to, I think there's now over like 10 billion of deposits to Anchor. And so the difference is made up by what they call the yield reserve. And basically what's happened is the Terra community basically wants Anchor to continuously offer these high yields because it creates demand for Terra, which actually de-risks UST a bit because you've got this constant, demand and use for UST. And so the Terra, I don't know who exactly it was, but they just recently basically filled up the yield reserve with like $450 million of reserve in order to kind of make up the difference to be, paying these really high yields. And, based on our like internal math, even this 450 million, like it'll last kind of maybe 6 months at the most. And then, they'll probably be in the same position at a certain point and have to kind of decide what to do from there. But yeah, that's a bit of an overview on Anchor. So I don't know, did you want me to talk about other stuff or does anyone have anything to add?
Oh, just one thing that I would quickly add, which I think is interesting, is with a lot of the research we've been doing with folks who are looking for different yield opportunities throughout crypto, just asking how they think about it and where they're participating. Far and away, what most folks are telling us is they're using Anchor right now as like that's like the most common thing we're hearing when we're doing research of what kinds of place where people are going right now for yields is Anchor for that. I think it's like 19.5% yield right now, which is really strong. But they also bring up at the same time those exact kind of concerns you mentioned, which is that in the span of say a few months, it's likely or looks likely that that reserve will be depleted, and then at that point the yields won't continue. So they've been keeping that in mind, but like that's what we've been hearing the most compared to like all of these different sorts of stablecoin yields we've been talking about.
So what I'm hearing is they're giving away free money, and that free money is going to run out in what type of time frame?
4 to 6 months, something like that.
So
depending on how much money is in the protocol.
And what happens when that reserve runs out?
No one really knows. There was a proposal about a week ago to adjust the distribution amount, so the yields paid to stakers, depending on how much money they've staked. So if you've staked more money, then you receive a lower yield. So if it's above $1 million, you're receiving like low teens, not 19. As a way to basically say, if you're a whale and you're staking a lot to this pool, then it's not fair for you to be taking so much of this free money because the smaller stakers are the ones that they're really trying to incentivize. But the other thing, so that proposal didn't pass. So we'll see what happens. But I think a concern that a lot of people have staking to Anchor now is, okay, what happens when the money runs out? Well, it's unlikely that the money's just going to run out. What's going to happen is that is that the yield is going to be reduced ahead of that so that the money lasts longer, or they raise more money or inject more capital into that reserve account. But in either case, it's not sustainable. And so, a lot of people are in the anchor trade right now, but it's not, we'll see how long that lasts. And, that being said, it is a very smart strategy for the Luna ecosystem overall. We understand why they're doing it, and it's really attractive. And, side note, it has gotten a lot of people familiar with using Luna in their wallets, the Terra ecosystem overall. And so, it's been a great experience for us. Everything works well there. So it's good. But I think one of the things that we look at is what is the sustainability of the yield. And so when we compare that to, for example, buying a Goldfinch backer tranche, it compares really favorably in the sense that the Goldfinch backer tranches have 3 to 4 years of sustainable high teens yield baked into them. And that's just in cash in USDC. And then, of course, there's the additional governance token yield that comes along with that, which obviously Anchor doesn't have any governance token yield on top of the 19.5%. So from an expected return perspective, the Goldfinch backer tranches are more attractive, in some cases significantly so, than Anchor. And the other thing is it's USDC stablecoin as opposed to an algorithmic stablecoin, which is what UST is, and that's what the Anchor protocol uses. So, Mike, I don't know if you want to talk about liquidity and stuff, but
well, I would just add one thing about Anchor is I'm looking at it now, and there are borrowers on Anchor, and the kind of returns according to the site here is that the borrowers are returning 11.5% APY. So even if the reward, even if that reserve is fully depleted, in theory, there's still 11.5% in yield being delivered to folks in the Anchor protocol, which is still 3 to 4x what these kind of 2 to 3, 4% rates you get in these other blue chip kinds of opportunities. So I look at that and I think, there's a lot of talk about, what happens when the reserves deplete. And so, yeah, you might go from 19.5% APY to 11.5% APY, but I still think Anchor will dominate in sort of the amount of capital that's there compared to the other blue chip options, because there still is, it's just 11.5% is still a very attractive source of yield. So I find Anchor to be really fascinating. And I think this approach with the reserve is a really smart way to grow the TVL early on. And yeah, it's not sustainable, but there seems to be still a pretty high sustainable yield even without including that reserve.
I think it will also be interesting to see how, since it is essentially a yield-bearing asset of staked ETH, essentially from Lido, I think it's going to be interesting to see how that yield also evolves in the coming roadmap of the Ethereum ecosystem, and whether that is going to. Right now, I think it's around 4.5% to 5.5% just on staking your ETH. So that will be interesting to see if that evolves in different ways. That could also impact Anchor.
Yeah, that's true. It's such a kind of a multivariable environment right now where there's so many factors in play, because there's different chains with different sorts of collateral, and all of these sort of integrated roadmaps are affected by each other. It's I think that makes it pretty tricky to predict how these things all will interact with each other. But they're all, what you mentioned, Greg, is a really important aspect there too.
Yeah, I wanted to add something to what Mike was talking about with, the borrowers on Anchor. So yeah, the borrowers pay, I think, close to 13% interest rate. I think right now though, there's only about 2.5 billion of deposits. So I think the real yield that they could be paying to lenders on the platform is more 6%, or 6 to 8%, if my math was right. Which it's still a lot higher than compounder Aave, to Mike's point.
Oh, I see. I think I was reading the dashboard incorrectly. So that rate that I was reading is just for the sub amount that is actually borrowed. But when you include
So when you borrow on Anchor, you actually earn the Anchor governance token because the way that Anchor gets sustainable is basically increasing the number of borrowers on the platform. So they actually try to reward borrowers, which is kind of an interesting model.
I just want to open up the floor if anybody wants to come up. I see one request, so maybe I'll bring Chinedu up to see if he has a question or wants to give any insights. Let's see, he's currently connecting. I guess in the meantime, while he's connecting, I would love to hear anybody's kind of future thoughts on, maybe in 12 months, how we might see the stablecoin ecosystem evolve. What do you think might change? Where are we going? Any bold predictions that we might see with stablecoins in the next 12 to 24 months to the group?
I can try to take a stab at that. I think one area I find really interesting is in kind of these non US dollar stablecoins. So, like for example, Rye, which is tied to Ethereum. I think that people in crypto generally, I think, have a bit, maybe not so much in the Ethereum community as in the Bitcoin community, but there's a bit of like an aversion to the US dollar and inflation and all this. So I think stuff like Rye, which stays stable using a mechanism kind of similar to DAI, but tied more to ETH than it is the US dollar. I think those might see some interesting adoption over the next year or two.
Yeah, I think overall people will start to get more comfortable with algorithmic stablecoins, and that will be a new source of money that flows into the crypto space. And what I mean by new money is, like I said, you don't have to back it with another asset. It's just net new capital. And so that will create a lot of interesting dynamics. And I think net, what will happen is as there's more stablecoin in the crypto ecosystem, the sources of yield that are being generated will go down because as the supply of stablecoin increases relative to the demand for borrowing on chain stays the same or grows but not as fast, then yields come down. Except for when you have off-chain versions of off-chain sources of yield or other new novel ways of lending and borrowing on chain or new ecosystems. So always the highest yields tend to be available in new ecosystems that are incentivizing either with stable coins or something else. And I think what we see with Anchor is an example of that.
Mike, any final predictions, and then we'll open it up to the floor for Chinedu for the next question after your kind of 12-month, 24-month prediction on stablecoins.
I mean, I kind of agree. Although, and then me providing the biased view, I see a huge trend over the next 2 years of, there's a certain amount of yield you can get from just these existing kinds of crypto protocols, but we really need to get crypto out into the world and use the whole economy that exists outside of crypto to provide more ways for stablecoins to work. And so I mean, this is part of the thinking behind Goldfinch, and there's other protocols doing this as well, but getting these kinds of yields from things outside of the crypto space, from real world borrowers, I think is going to drive a lot of activity from stablecoins over the next 2 years.
Yeah, I think for my final thought on this one is I think my prediction is just seeing a lot more stablecoin onboarding opportunities, whether it's kind of direct deposit from your typical work checks, or people being more accessible to be able to put their kind of fiat into stablecoins, because the yield opportunities are, even at the 2% numbers of the blue chips, so much more attractive than your 0.05% yield sitting in your Bank of America or similar banks. So I think my prediction is kind of seeing many more stablecoin onboarding opportunities and tooling in the ecosystem that enables that. Maybe now we'll hop open to questions. Chinedu, go for it.
I had a question that was kind of answered already, but I did want to give some other comments on some other topics. I don't know if that's permitted, but
yeah, go for it.
Yeah, so. I do remember at a point last year the anchor reserve was increasing, like between November to sometime in January. So it's really reflective of the market when there's a bear market and no one wants to borrow money to leverage trade and stuff. The reserve goes down. So I don't think it's a foregone conclusion that the reserve will continue to be depleted. I mean, I think there's a consensus that this situation might remain for a little while, and if so, that's the case. But in terms of, I'm very familiar with Goldfinch actually, and I know I think one thing that I've been seeing is that it's liquidity in a lot of these DeFi protocols and stablecoin yields tend to compete with each other, and I think a product like Goldfinch is it'll be so useful for a lot of real world investors as well. But you're really competing with a lot of the crypto DeFi yield farmers because essentially are using you need to be connected to crypto and have a MetaMask and all these things to be able to access Goldfinch. But I think if there was some way, like someone already said, for you to allow people to invest directly without having to go through those crypto hoops, you'll see a flood of capital. Just because I know, at least in this market that I'm in, which is Africa, Nigeria, etc. Everyone's looking for yield. That's what everyone is chasing, and everyone wants dollar-denominated yield. So someone also asked the question about the stable coins and trends, and I think one thing that's been happening with this whole Russia-Ukraine situation is that a lot of people, at least in this market, a lot of HNIs are starting to see that they're not really protected, that you could actually be canceled. Your SWIFT, your net worth can be taken. So people are actually looking at stable coins a lot more now in this market. And I think something that I'm working on is helping to onboard people who don't have crypto or crypto involvement, whether they be fintechs or enterprises, to this sort of market. So I think all these things are interesting, but that was my piece.
Yeah, I mean, I think that's a really really great insights. I think we're seeing a lot of interesting activity right now in the crypto sphere with some kind of political challenges around the world that might evolve the ecosystem, might not. But I definitely also agree with you on kind of how you might more easily onboard institutional money or fiat into the crypto rails without necessarily having to go through everybody's favorite tool of MetaMask in different ways. So I think there's definitely a big wallet evolution that's needed there, as well as kind of more exposure to opportunities in the institutional world in different ways. Not sure if Rennick, Mike, or Eli have anything there.
Yeah, I think one of the great things about crypto is it creates the ability for people around the world to access things without having to go through their local fiat currency. And I think everything we're seeing in the world today related to money transfer and value is that decentralization matters. That's all I have to say for that. One other thing to note, actually, on Anchor and UST specifically, is that they also do have $3 billion of Bitcoin backing them. I think, we didn't really talk about that, but they do have a significant amount of reserves for this to maintain the peg of the stablecoin. So that certainly helps things there as well.
All right, thanks. Intramurals, any questions, comments, thoughts?
Hey guys, thanks for holding this thing. I think definitely very interesting topics being covered here. I guess my question is similar along the lines with respect to kind of being able to onboard more capital and being able to onboard more, perhaps like either individuals or institutions. With respect to, so the current thread I'm feeling from this conversation is that a lot of the capital that's flowing to protocols like Goldfinch really focus on the crypto side of yield, primarily because the access is through the wallet points. That being said, we all know that if you're operating with real world assets, there is a sort of different type of probably more established like yield curve, right? Like whether you're looking at venture-backed debt opportunities or whether you're looking at, quote unquote financing, like, just traditional debt, term debt, or actual assets. I guess my question was more along the lines of what efforts have been to date with respect to being able to actually sell that side of the story a bit more as opposed to competing on the crypto side of the story. Are we there yet? Or is it that today it's really early stage and that really the only capital available is like crypto oriented capital? So, delta neutral hedge funds and whatnot, such that we're not even there yet with respect to being able to sell a more nuanced story. And by we're, I'm kind of referring to like Goldfinch. And I think this conversation is helpful to get Stratos input as well, is because I'm pretty sure that the Stratos team has sort of been able to kind of see that too, right? With respect to, okay, these are quote unquote the types of LPs or investors that they have on the other side. Like what's preventing them from probably doing a direct jump into just investing in Goldfinch? Is it just a wallet problem or is it something else? I know it's a lot, but I'm trying to condense it.
Yeah, I can start by sharing a little bit of what we've been hearing from folks, and then I'd love to hear, from Rennick and Eli about what, how you guys think about it. But when we chat with folks from a range of individuals to sort of traditional institutions, for the institutions that haven't yet gotten into crypto, the conversation is like, what is crypto? How does crypto even work? Why is crypto beneficial for the world? Like, we've heard like when we've reached out to folks that we know, and some of them will respond being like, oh, we haven't gotten smart on crypto yet, so like they like we can't really think about this right now, and they have to go through the first step of understanding what is Bitcoin and do they want to own a little bit of Bitcoin or something like that, and then make their way all the way to these crazy DeFi protocols and how to participate in them. So the kind of learning curve there with talking to really traditional sort of long-standing institutions and funds is like they have to go through a whole process of just getting comfortable with crypto in general before they can even look at something like Goldfinch. There's a world where Goldfinch could be their introduction to crypto, which is kind of an interesting thing, but it's kind of like doing two things at once. It's convincing them about crypto at the same time as explaining how Goldfinch works, versus with a lot of the capital that is already in the space and talking to people who I might call them like crypto pros who are really into it. Like they're already into crypto. And they're excited about it, and then that is like a different kind of conversation to have, and usually kind of fewer steps to get comfortable with Goldfinch.
Yeah, I think what Mike said is pretty spot on. There's just a huge knowledge gap with most investors. There's tons of money out in the world that would love to get these kinds of returns, but it takes time and effort to learn and understand new things. And, it takes time to get there. Just like any other technology, it just takes, think about when the internet was new and, people didn't really want to bother with it for a while until everyone was using it. So I think that's a similar thing here. I think the wallet issue is a really significant one. As you phrased it, the wallet issue. And I think if you just look at Grayscale, the company that offers the Bitcoin and Ethereum Ether ETFs, or the trusts that trade on liquid public markets, there's billions of dollars in there, and they're charging 2% per year or something like that, which is a ridiculous amount of fees for essentially buying crypto and putting it into a traditional legal structure so that public markets investors can buy it. Because you could just go straight and buy and hold BTC or ETH yourself, but so many people aren't comfortable with that Grayscale is making hundreds of millions of dollars doing this, just solving that wallet problem. So it's real, and I think hopefully there are some better solutions in the works today that will help more traditional investors get comfortable with the idea of holding crypto keys, or at least interacting with crypto in some way. But then the other part for us and our stable yield investment products is there's a lot of research that goes into picking that portfolio and how you want to allocate across opportunities, and then staying on top of what's happening there, the current information on Anchor, and kind of deciding how much of the portfolio should be in there given some of the uncertainty, and where else do we want to stake those assets. That's just kind of classic investment management, portfolio management, that a lot of investors are happy to pay, give the money to someone like us and pay the fees for us to do that for them, because they've got other things going on in their lives and they just don't want to bother doing it themselves. And I think what we see in DeFi today is a lot of people who are willing to take the time to go and manage things themselves. But that's because what we're seeing in DeFi today is like the population of early adopters. But as DeFi grows and more people are accessing these services, I'm expecting that more people are going to want to just set it and forget it and put their money in a DeFi yield or a crypto yield bucket and just move on with their lives. Because the level of financial sophistication that's required to really figure out what's going on here and allocate to the right risk returns is, most people don't have and don't want to bother with.
Yeah, I wanted to add a little just on the operational side of things of investing institutional level money. I mean, you can't just, open up a MetaMask on your computer and, take millions of dollars and put it into Goldfinch, right? We have to use basically a multi-sig and, have a bunch of policies in place. And so I think to your point, to Rennick's point, wallet infrastructure, I think is going to be a big part of onboarding new institutional money. And then on that front, I actually think that one of the most interesting things out there is Wallet Connect. And I know that Goldfinch recently added support for Wallet Connect, which I think is awesome. That makes, basically everyone who's using a Gnosis safe, everyone who's using Fireblocks, a lot more comfortable, I think, putting money into Goldfinch, which is great.
I guess what I'm hearing from what you guys are saying is that really, protocol partnerships with DeFi native funds that are sort of savvy with respect to underwriting the types of backer pools or whatnot is going to be a key strategic advantage going forward. That's one. And the other part of that is, and this is probably more of a question, what are your guys' thoughts about and with respect to DAOs or DeFi native structures that are up and coming now? Is that more of a marketing thing to be able to kind of build platforms because the size and the bite sizes are too small? Or is it more of a development thing with respect to these things could potentially be, our vision of something that's fully decentralized, going forward, such that it's worthwhile to kind of get into that right now? I'm just thinking more about that from a kind of scaling Goldfinch type perspective. The targeting DAOs and DeFi native or Web3 native investment platforms perspective.
Yeah, well, I would agree with you that being an institutional investor that has experience across the risk return spectrum and digital assets is unique these days. I think that will change over time. And so being able to work with some of our portfolio companies and other companies that maybe we haven't invested in or protocols that we haven't invested in yet, but being a liquidity provider there is provides a very interesting opportunity set. But in terms of creating crypto native versions of these structures, we're actually working on building one now because, as we suspect, there are a lot of people holding crypto who would be interested in staking to a diversified stablecoin yield strategy that's managed by people who know the space well, just in the same way that there are traditional investors who want to do the same. And so there are some limitations to doing a crypto native version. You can't just allow anyone into it. You have to KYC people. You have to, make sure they're accredited if they're U.S. investors. unless, of course, you create a decentralized version, which then, on the one hand, is more scalable and doesn't necessarily have the same kind of KYC requirements, but on the other hand, means that the community would govern the portfolio allocations rather than a centralized group like us. So there are trade-offs there in terms of design, but certainly, going to other DAOs and other crypto native, quote unquote, institutions as opposed to individuals is also a great source of capital. There are so many treasuries that have so much money that's really not being diversified well or not earning yield where it could be. So it's an ongoing discussion for us, and I know one for Goldfinch as well.
Yeah, I would just add that taking like a sort of a longer term macro view, I would predict that over time the vast majority of capital that is invested within the DeFi space will be done from folks who are not the ones who are actively picking and choosing. It'll be from folks putting it into, like, basically leaving their funds to other people to make those calls for them. I think right now it's primarily all sort of individual people or institutions making their own decisions, but I think it'll move towards primarily passive capital. And there's a few ways that could happen. It can happen through institutions raising capital through traditional ways and then picking and choosing the way we've kind of discussed. It can come from folks creating funds that are raising capital either like potentially directly on chain or in other ways. And then also I think DAOs is a pretty interesting approach too, where it's like a number of folks can provide capital to a DAO, but then there's like some smaller group who are actually making the decisions on that. I would just predict over the long term that the vast majority of the capital that's put to work is done so by like passive investors, leaving it to more sophisticated and active folks directing that capital for them. Oh, another example would be just like products integrating with DeFi protocols, just like you participate in some sort of a yield product and it's just automatically doing it for you.
Great, thank you all. Any final thoughts? Figure we'll kind of wrap this up in the next 3 or 4 minutes. Any final closing thoughts?
The one thought I have is just it's, for me, what I love so much about this space is how quickly it changes. So I feel like everything we're talking about with the different options, the different kinds of trends we're seeing, what's going on with Anchor and the Reserve and different kinds of ways of participating in the wallets, I think in 4 to 6 months, it'll probably be a very different story. So we should definitely return to this again in the future because it's interesting how quickly these things change.
Rennick or Eli, anything before we kind of sign off?
Nothing to add on my part. Thanks everyone for listening.
Yeah, I think I'm definitely excited about how I think more like institutional money comes into the space and sees, all of this yield opportunity that they can't get in traditional markets, especially with kind of like the macro state of the financial system. I think that there's going to be a lot of money searching for yield, and DeFi is in a really good position to take advantage of that.
Great. Awesome. Thanks everybody for joining in today. I'm sure we'll probably be doing another stablecoin conversation or other future spaces. So follow the panel on stage, and thanks everybody for joining.
Thanks for listening, Greg.
Thanks, Greg.
Yep. Bye, guys.